journey in your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
To understand how corporate dividend taxation works, the first concept you need to learn is the idea of connected corporations. This classification is extremely important because it determines which tax rules apply to dividends received by a corporation. A connected corporation is a corporation that has a close ownership relationship with another corporation. In most cases, one corporation owns a significant portion of the voting shares of the other corporation or exercises control over it. A common example is a holding company, often called holdco, and an operating company, or opco. The holding company owns shares of the operating company, and because of that ownership, it is connected to the operating company. Another common example is a parent company and its subsidiary. The parent corporation owns or controls the subsidiary, creating a connected corporate relationship. Similarly, related corporations within the same corporate group are often connected for tax purposes. The key point is that these corporations are not simply unrelated investors buying shares in the stock market. Instead, they are linked through ownership, control, or a significant economic relationship. Why is this distinction so important? Because when dividends are paid between connected corporations, the Canadian tax system recognizes that these corporations are closely related. As a result, those dividends are generally subject to a different set of tax rules than dividends received from ordinary investment portfolios. At this stage, you don't need to memorize the exact ownership tests or technical definitions. Those details can come later. For now, focus on the overall concept. Whenever you see one corporation owning or controlling another corporation, you should immediately think connected corporations. As a tax preparer, this becomes your first question whenever a corporation receives dividend income. Who paid the dividend? If the dividend comes from a corporation with which there is a significant ownership relationship, you're likely dealing with connected corporations, and special corporate tax rules will apply. In the next slide, we'll compare this with the second category, portfolio dividends, where a corporation simply owns small investments in unrelated companies. Understanding the difference between these two types of dividend income is the foundation for learning Part 4 tax, refundable tax accounts, and the rest of Canada's corporate dividend taxation system. Now let's look at the second category of corporate dividend income, portfolio dividends. Unlike connected corporations, a portfolio dividend is received from a corporation in which the investing corporation has only a small ownership interest. The corporation is simply investing its surplus cash, much like an individual investor buying shares through the stock market. Imagine that an investment corporation purchases small percentages of shares in several different companies. It might own 2% of a bank, 3% of a technology company, 5% of a retail company, and 1% of a mining company. Although the corporation owns shares in these businesses, it does not control them. It cannot direct their operations, appoint management, or influence major business decisions. It is simply one of many shareholders. When these companies declare dividends, the investment corporation receives dividend income based on the number of shares it owns. These payments are known as portfolio dividends because they come from a diversified investment portfolio rather than from a closely related corporation. The key difference between a portfolio dividend and a dividend from a connected corporation is the ownership relationship. With connected corporations, there is usually significant ownership or control. With portfolio dividends, there is no significant ownership, no control, and generally no meaningful influence over the company paying the dividend. This distinction is extremely important because Canadian corporate tax law applies different tax rules depending on the type of dividend received. As a tax preparer, whenever you see dividend income on a corporate tax return, one of your first questions should be, does the corporation control or significantly own the company paying the dividend? If the answer is no, and the shares are simply held as investments, you're most likely dealing with a portfolio dividend. In the next slide, we'll place connected corporations and portfolio dividends side by side so you can clearly see the differences between them. That comparison will provide the foundation for understanding why the Canadian corporate tax system applies different rules to each type of dividend income. Now that we've learned what connected corporations are and what portfolio dividends are, let's compare them side by side. This is one of the most important distinctions in Canadian corporate taxation because it determines which dividend tax rules will apply. Let's begin with connected corporations. A connected corporation exists when there is a significant ownership relationship between two corporations. Typically, one corporation owns or controls another corporation, such as a holding company owning an operating company, or a parent company owning a subsidiary. Because these corporations are closely related, dividends paid between them are generally subject to a special set of tax rules. Now compare that with portfolio dividends. In this situation, the corporation simply owns small investments in many unrelated companies. It may own a few percent of a bank, a technology company, a retail company, or several publicly traded corporations. The corporation receives dividends because it owns shares, but it has no significant ownership, no control, and no meaningful influence over those businesses. Although both situations involve one corporation receiving dividends from another corporation, the ownership relationship is completely different. And that difference is exactly why the Canadian tax system treats them differently. As a tax preparer, every time you see dividend income on a corporate tax return, your first step should not be to calculate tax. Instead, your first step should be to ask a simple question. Where did the dividend come from? Did it come from a corporation that is connected through ownership or control? Or did it come from a portfolio investment in an unrelated company? That single question determines which corporate tax rules you need to apply. If the corporation has a significant ownership relationship with a payer corporation, you move into the connected corporation rules. If there is no significant ownership and the shares are simply passive investments, you move into the portfolio dividend rules. Notice that, at this stage, we are not yet calculating any tax. We're simply identifying the correct category. This classification always comes before the calculations. As we move into the next chapters, you'll see why this first decision is so important. Concepts such as Part 4 tax, refundable dividend tax on hand, and dividend refunds all depend on whether the dividend came from a connected corporation or from a portfolio investment. So, the key takeaway is simple. Before calculating any tax on corporate dividend income, always identify the type of dividend first. This single classification determines the tax rules that apply and forms the foundation for everything you'll learn in the remaining sections of this chapter.